One of the great strategies that you guys turned me on to is the cost segregation strategy. I've been able to do that because I've had, geez, I don't know, 7 commercial properties now. I had all this opportunity for multiple commercial buildings to utilize that strategy all at once. And then we recently purchased a large business building here in Prescott, where my business headquarters is, and we were able to utilize cost segregation again with the build out and the purchase of the building. Can you guys just give us kind of just a high level explanation of what that is and who can take advantage of it?
If you're going to do cost segregation, I think if you're worried at all about any future audit risk, the best thing you can do is work with a specialist firm that's all that they do. And the best specialist firms have engineers working with the CPAs. Mm-hmm. And the engineers come out on site and the engineers create an engineering report. And the better that documentation in that report, like back of napkin stuff, which we do see, that's high risk. You might pay a little bit more, but to have an engineer come out and do the breakdown of the components of your building and do it in conjunction with a specialty CPA firm that's all they do is cost seg, that's going to be your best bet to kind of cover your butt on that.
Mm-hmm. The bottom line is it essentially is a tax strategy that accelerates tax deductions. So we think about the time value of money. Would you rather $50,000 today or $50,000 over 39 years? So the strategy is simply an engineering and accounting concept married together that looks at the cost components of a building and breaks it down into different depreciable lives, maybe depreciating computers over 5 years and maybe cabinets over 7 years, but same thing for the building. So they're breaking it down into smaller buckets or depreciable lives. And then through the cost segregation study, we can then apply accelerated depreciation to that. So as opposed to, let's say you have $1 million building, taking a deduction evenly over 39 years, I know that about 35% of the cost of a building potentially qualifies for first year or accelerated depreciation. So if I could take $350,000 today as a deduction, 40%, that creates $130,000 savings versus, taking $20,000 a year. I mean, to me, it's common sense. Mm-hmm. The key thing is you will not lose a deduction if you don't do a cost segregation study. In my opinion, it's simply about time value of money. How do you create cash flow today by lowering the amount that you have to leave out of your pocket to the IRS?